panel is entitled Negotiating the Deal. Our moderator is Mr. Peter Robinson. Peter is an associate professor of law at Pepperdine's School of Law here on the Malibu campus. He has presented advanced negotiation and mediation skills courses in over 30 states in the U.S., as well as several countries in Latin America, Europe, and Asia. The Southern California Mediation Association has recognized Peter as Peacemaker of the Year in 1999, and Los Angeles Magazine has recognized Peter as a Southern California super lawyer in the area of mediation. Please provide a warm round of applause for Mr. Peter Robinson.
Welcome and good morning. It's our joy to frankly present to you four people who have amazing experiences to share with you. As we've organized this panel, we've really taken four different slices of buying and selling a company. And each of them have unique stories. I want each of them just to take 1 minute and introduce their full bios are included here, but just to give a second to go before they dive in on each of their topics, just to let them know a little bit about yourselves. Starting with Scott.
Me, I go first?
Yeah.
Hi guys, good morning, I'm Scott Fennel. I practiced law from 1988 to 2003. The first 10 years were in litigation. Can you hear? Is that better? Yeah. Okay. First 10 years were in litigation. The last 5 years, I created strategy and executed it for motion picture studios and record labels. Since then, I have a consultancy called Level 11 that we create and execute consumer-facing strategy, and we've started and sold a couple companies in the entertainment business.
Good morning, Deborah Sweeney. I am a JD MBA graduate of Pepperdine and also became a lawyer for a while there and did litigation. I was outside general counsel to the company I now own, went in-house. We had a bid for an acquisition from a company called Intuit, which does QuickBooks and Quicken. We were acquired. I ran the business under Intuit for 5 years, and then last October, I bought the business back from Intuit. So now, wonderful being partners with Intuit, but nice to have a business that I can actually make move, because under a huge corporate organization, that's not always so easy.
Hi, I'm Daniel Smith, and I have a JD from Pepperdine Law School and undergraduate in music business from Belmont University in Nashville. And I'm counsel at Guitar Center, and I have primary responsibility for advertising, media, and technology for the enterprise. And prior to being at Guitar Center, I worked for Salem Communications, which is a publicly traded radio broadcaster. And before that, I had a career in technical and executive recruiting.
Hi, I'm Mike Woronoff. Don't have nearly as interesting a career as they do. So I have been practicing law for 25 years, didn't go out and do anything else, and currently run the capital markets, M&A, and securities practice at Proskauer in LA.
The four themes that we've identified, and each of them are going to take one of these and have special expertise in, is Scott's going to start us by talking about starting up and positioning a company for sale. After that, Dan's going to follow up with talking about purchasing a company. After that, Deborah's going to describe her experiences in, I think, being bought, and maybe if we have time, buying back her company. And then Micah will talk about the dynamics between the principal and the advisors in a negotiation. Again, the focus here is the negotiation when you're largely buying and selling your companies. So we've asked each of them to take 8 to 10 minutes each, and then to leave room at the end for questions. So that's our goal. We'll see how well we do at accomplishing that. Scott, we'll let you start us off.
Okay, so can everyone hear? All right, so.
Well, that was not convincing.
Sorry, that's right. Can everyone hear? I'm getting flags from the back.
Let's get closer.
How's that? All right. So this afternoon in real life, I'm actually going to do a meeting at 3 o'clock here in Santa Monica, where a small Santa Monica-based startup that has raised $800,000. It is fully deployed into software. The software, in essence, does some 3D rendering. That's all I can say. Is being approached by a major player in the space for the initial meet and greet to be acquired. So I'm going to kind of tell you what we're really positioning this afternoon to do. Because it's funny that I was preparing for that meeting last night, and it was exactly what I'd talk about this morning. So the history is the startup comes out of 2 kids from Arizona State University. They were high school friends. They were college roommates. They came up with this idea their senior year of high school. Their parents each put up about $100,000. They took 1 year post-graduation to develop the software. They learned that they could not write the software in-house. So the parents put up another $450, so they're all into it now for $800,000. They went out to a software design team first based in China. That was a disaster. They second went out to a team based in Russia, which actually works. So now they've got a fairly functioning piece of prototype. They then launched it into a particular market in 2007. It got some traction, and it was deployed in dozens and dozens of institutions that use this particular application. They then learned their revenue model did not work, that what they thought they were going to give away and then be able to upsell, the upsell piece didn't happen. And so they spent a year retooling their revenue model. They launched Revenue Model 2 on the same software. They started getting some revenue. They learned in Revenue Model 2 that their ticket price was too low to cover their cost of goods and their going forward ability to scale. They came to us and they asked us to help figure out a new market entry strategy and potentially a new revenue strategy. There's the background. To do that, we reevaluated their customer retention rates and we reevaluated their ticket price at 100,000 feet. As a result, we identified a new niche that they can approach that has a higher ticket value, and so we then approached the biggest player in the space because we needed a joint venture partner to take the software to the next level. That's the meeting this afternoon. So that's the background. So let me tell you the 5 or 6 key questions I have these guys preparing for tonight. The first question is my guys need money, and they need money to take the software to the next level. But to get that money, they're going to have to answer a question to the biggest player that I think is important, is why do you need me? What pain do I solve? What value do I actually add for you, big co? And so my guys have spent about 3 weeks really thinking through, that critical question, why do you need me? Because as much as my guys are cool and hip, the truth is these guys that are buying them are worth about 150 times more than they are. So that's the first focus we've concentrated on. The second thing we've concentrated on is we've asked them to decide what it is we can do for you, the timeline that we can do it in, and the chronology to get you there. So I've asked my guys to really focus on the execution and the operational side because big co buying new co really wants to get its investment deployed as fast as possible and start to get to ROI. So my guys have spent a lot of time thinking about the operations of it. Then and only then do my guys get to start thinking about profit and exit and what are we actually going to do if we can actually make this deal happen. So from 100,000 feet, as a startup, I think many people come in at saying, I'm the coolest thing in town, and therefore you're going to want to play with me. But when you're positioning your company for sale, or to, in this case, to be bought, really you've got to figure out what is the value you're adding to the bigger player. Because if you can't make a difference in their bottom line, if you can't move their operations, if you can't bring them value, I don't know why they're going to buy you. And as much as you'd like to think you're really the next thing, you've really got to show the value add piece. In the case of this afternoon, these guys got that, they love that, and they're all over it. They are really, really thinking for the first time from the perspective of Big Co. And I'm fairly confident they'll actually do a deal because Big Co really likes the application, but Big Co has figured out it's a lot cheaper to buy the application than to try to reverse engineer it. There's some patents and some IP in place. Piece of advice for all of you guys wanting to start up, if you've got something you can protect, you need to protect it. And I think Michael will talk a bit about some of the IP, and I know Dan will too. The IP piece is important because in this market, Big Co, in my case, could literally have reverse engineered this, but for 3 or 4 critical patents. And they certainly had the cash flow to do it. So my guys, way before they got to us, had correctly protected their IP. Their mistake, if you will, is they had not correctly identified their revenue model and their market coming out the door. But they were willing to recognize their oops, and they quickly corrected course. I think another piece for startups is, you're not going to get it right out of the box. You need to keep it malleable. You need to keep it fluid enough that you can adapt, especially when opportunities present themselves. So I think that's about 7 or 8 minutes, and I think I'm good.
Peter.
Hello. So, when you are working for a company or in a firm representing a company that's looking to acquire another firm, you're going to obviously have to have some good negotiation skills because there's so many details that have to be properly handled in order to have a successful acquisition and integration. So I like to talk about this a bit in the context of using negotiation skills through this process and use some examples. So obviously you have to look at the context of the acquisition, and the objective would be to acquire the company and not pay too much and not take on too much of their pre-existing liability. But the context could be that you're buying out a public corporation or maybe a private, closely held corporation, or it could be friendly, where the founder's son wants to cash in, big bucks. Or it could be unfriendly, where you're, essentially taking over a competitor that doesn't want you to take them. So, you could be in a bankruptcy or an assignment for the benefit of the creditors, where you're really looking at an auction and, they're looking just to maximize the estate. So you're going to want to look at your plans on why you want this company, what are you going to do, and what its value is to you, because you've got to get a benchmark on the price. Now, if you're in a bankruptcy situation, there's going to be auctions. They're really looking, for the most part, on getting the most money for the assets of the company. But if you're not in that situation, the seller is going to try to make it as inflated as they can. So there's quite a bit of diligence that has to come in, but there's going to be a benchmark price that comes down the way. And then the acquiring company is going to want to do a huge amount of diligence. They got to look at the assets, the liabilities, the ongoing viability and trends, and what kinds of encumbrances are on the business. So in that process, you've got to go through and really examine every aspect of the company. So you've got to look at their real estate holdings, their leases, their intellectual property, any employment agreements, strategic relationships or positioning might be all that somebody wants. If they have a chance to get in with the right market opportunity, that might be enough to buy the company no matter how much the assets are worth. And then, of course, the technology, as Scott was talking about, and the portfolio of what kind of technology they have enabling their business. Guitar Center acquired Music and Arts Center in 2005 for about $100 million and paid mostly cash. So that's another big point, is financing. Because if you're doing a really large acquisition, by comparison, you're going to have to get some kind of underwriting, whether you're going to trade stock or whether you're going to sell bonds, or whether you have firm commitment from somebody to raise that funding from different places. So there's a lot of negotiation involved in getting a commitment from the source of funding. Of course, if you have the cash to buy a company, then that's not as big of a deal. When Guitar Center acquired Music and Arts Center, they had a division called American Music Centers that was losing multiple $1 million a year, that supported the band and orchestra industry, music instrument rentals for students, and the chain was acquired some years before, and they just hadn't been able to do it. Music and Arts Center was started by the founder, who was the father of the then current owner, and they had developed strategic relationships with schools and positioned themselves in the hot places to get in with the band programs of the biggest schools. So Guitar Center was interested in buying that brand out, integrating their struggling brand with the music and arts brand, and then growing that business and improving its profitability. There were some very interesting negotiations over the leases, because when you have essentially a non-attorney leasing small stores, they're signing leases that have all kinds of stuff that they don't really, they want to know how much the rent is. So we ran into, after, of course, a huge amount of diligence on about 60 or 80 leases, where there was all kinds of really bad clauses saying that you couldn't assign it without permission. And the assignments were often deemed assignments. So if you acquire a corporation, that's not an assignment. But the lease would define that if this one guy didn't control the company, that it was an assignment, which required consent. And of course, once you went through the 80 leases and found out half of them needed to get consent from landlords that were interested in trying to take a piece out of the deal, then you had a huge risk of losing stores. And every store that might have been lost would have been a risk for the price of the deal. So the concept of indemnification, a bucket of money that would be put in reserve for those eventualities and caps. And then contingencies were put in place so that a certain amount of those consents had to be obtained. Now, there was other conditions, of course, like employment agreements, because Guitar Center wanted the management to continue on the company. They didn't want to try to figure out how to operate a new business. So, and of course, there's HSR filings, so you have to clear the antitrust concerns. So anyway, the deal closed, they got the assignments, and they integrated the company. So there's a lot going on in the integration where you have to take management, IT infrastructure, purchasing, and the like, and bring that into a way where you can manage it from the parent's point of view without destroying what's making this sub work. I'll give you one quick additional illustration, and that's an acquisition out of a bankruptcy. And in 2007, Guitar Center's subsidiary Musician's Friend acquired the woodwind and brass wind out of bankruptcy at auction. And the partners had, it was an interesting tale where the partners were going to buy, one was going to buy the other out, the other was going to sell, then they changed their mind, then they put each other in default, kicked a partner out, litigation pursued, and one of the partners won a $10 million judgment, executed it on the company, and put it into bankruptcy. So, needless to say, Guitar Center bid on the company, was going to get the stalking horse, and one of the vendors, a music instrument manufacturer, matched the bid and threw their $3 million in receivables on top. So the bankruptcy court said, well, that's the better bid, we'll go with them. Well, in negotiating this deal, Guitar Center was savvy enough to understand that the reason this other company put the bid up is to get the bid higher, because there was only one other bidder. And when they did that, Guitar Center went home, leaving a company that had no intention of paying $37 million to buy a competitor of all their customers. So, needless to say, they fell out of their purchase deal. The bankruptcy court went after them for the loss of the estate, and Guitar Center eventually bought the company for millions of dollars less, and still was the only bidder. So, in bankruptcy, it's a whole different ploy with negotiating, because the creditors were the ones that were trying to get the maximum deal out of the transfer. And then, of course, the employment agreements were pretty critical too. And it was a little bit messier because you didn't have a friendly buyer that was going to stay friendly. So I guess that's my short summary on buying a company, and I will...
Me. So I have a sort of a theme to mine, which is that you don't always have to follow all the rules. And that is that I sat in a chair always listening to panelists tell me, here's what you need to do to sell your business and what you need to do to buy a business or acquire a business. And I am no rebel by any means. I follow most rules. But I'm sort of creative in strategy, knowing that sometimes, as wonderful as lawyers are, and I am one of them, they can sometimes cause you extra stress and undue deal points and factors that may not actually positively impact the outcome of your deal. So a good example is that I was general counsel for my corporation, which is the business I own, and I didn't have an emotional component to it per se, because I had no stake in the game from a monetary standpoint. I mean, I wanted the best for the owners, and they were negotiating and a little bit off the cuff, coming up with numbers and figures, and just randomly, no valuation, really no assessment. Intuit walks into the picture, says, we'd like to be partners with you. Next thing you know, they said, okay, 10 million, no, 50 million, no. Kept going back and back forth, 20 million, done. 7 months later, after lots of negotiation and points, it really came down to the legal team at Intuit saying, I don't know about this business. It's questionable, they're slightly disorganized, they're sort of random. And what ended up happening was that the Intuit business team that sought to buy the business said, nah, we don't care what the legal team says. And so it's true. And I learned it later because I spent 5 years at Intuit realizing that that's sort of how deals are done. And it may just be at Intuit, not that anything's wrong with Intuit, but it may just have been that they were sort of laissez-faire and really more emotionally connected to a business. But the reality was that all the underlying concerns were not issues. They wanted to buy the business. It was a relatively good business. It looked interesting, and there was opportunity for growth potential. Fast forward 5 years, and the economy was not doing as well, and I saw that Intuit was sort of slowing up on their acquisitions and potentially divesting some businesses, and the non-conventional me said, what if I, now the general manager of the division, offered to buy it? And I mentioned it, of course, to a couple of my lawyer friends, and it's no chance. They're not going to sell it to you. They'll put it on the market. That's not the conventional way of doing things. They'll try to get bidders. They'll sell to some other competitor. They'll close it down. And I said, well, God, I don't know why they wouldn't potentially sell to me. I know what I'm doing. I'll pay them for it. It'll take it off their hands, and it won't be a liability for them. In fact, I'll assume most liabilities. Next thing you know, the lawyers say, you're crazy. Why would you assume the liabilities of this business under a publicly traded company? You're insane. And I said, I know what I'm assuming. I've run this business for 5 years. I think this is a nice opportunity. So Intuit said, well, present us your situation. So I put together an Intuit style because we're only judged at Intuit by our PowerPoint presentations. That was the corporate world, and I was shocked because I was, I think, an entrepreneur in my heart. Even being a lawyer, I kind of had my own partnership and ran my own division of the law firm. Anyway, so I put together a PowerPoint, and of course, my 4 slides said, you could sell to a competitor, you could close it down, you could do this, and then the very bubbly, happy slide was, you could sell to Deborah Sweeney. And waited about 2 months, and they said, we'll take that one. We'll sell it to you, and at a much lower premium than they bought it for. And oh my goodness, because we think you guys are wonderful and you're a great team, and we believe in your employees, and we want to remain partners. So could I have had a better situation? We're going to remain in TurboTax, and we're going to be a subline in QuickBooks, and we maintain all of our partners that we had established, the 200,000 CPAs that Intuit has under their kind of umbrella. And they said, okay, Deborah, good luck. And 1 year later, we're profitable, and I can't give all the figures, but we weren't profitable under Intuit. And so about a $6 million turnaround, and I guess I attribute it all, and it's not just about me, but I think about an entrepreneur's mind, to thinking outside the box. I think if I listen, when I obviously had to hire a lawyer when I thought I could do it myself, and everyone said, you're absolutely insane if you think you can negotiate this deal with Intuit and not keep a clear head when you're acquiring it. So I hired a lawyer, a team, and I needed it to be no one who was my friends, nobody who knew the business, because I was just frankly didn't want it to become public or anyone to know what the issue was. So an old law clerk of mine who had moved back east to New York, I hired him and said, can you and your firm support me in this acquisition? And so I negotiated all the points, and again, a PowerPoint presentation I put together and told them Intuit, here's what I think, and they responded and said, okay, we agree to most of your points. Let's just keep this really simple. Great. So they draft up the agreement. I figured that's fine. Most people would say no because you want to draft your own agreement, but I thought, well, I'm going to save a couple $100,000 if they draft it and then give it to me. So we did that, and then I asked them, can you pay my legal fees? And they said, yes. And so they paid for the negotiation of my own attorney. So I just kept being nice and kept thinking, well, what if I try this? And what if I ask that? And they kept saying yes. And I think sometimes people think they have to follow the rules. And I kept thinking, well, why not ask? And why not do it nicely? And why not see what they come back with? And then I sent it to my lawyer after they drafted the whole agreement. And my lawyer came back after a week and a half with, I want to say 25 pages of red lines. And I thought to myself, as I'm being my mom, dropping my kids off at their school, God, I don't know what this isn't my style. It's gazillion red lines, and they're going to get mad, and I'm going to get mad, and they may say never mind, and then where am I? And so my lawyer said, just do it, just send it. So I closed my eyes, hit the send button. 5 minutes later, Intuit called me and said, done, we're not doing it. You're crazy. Like, you did this on, you're a good person, we trust you, you trust us, and you're gonna come back with this. I said, ignore every red line. I just have a couple things I wanna change, and I'll sign the agreement. And of course, my lawyers wrote me a nice letter, as lawyers do. This is against our better judgment. We would not recommend that you sign this deal. But I was getting a phenomenal deal at a really good rate with the intellectual property that I wanted, and I was in product and had a great partnership with Intuit. I signed the deal, and a year and a half later, I could not be happier. So I guess my point is that sometimes there's rules, and a lot of times there's lawyers, and I think I'm really okay to say it because I am one, so I feel like, I know what it's like, and I know what it's like being the lawyer and being careful to cover your own self. But sometimes you don't always need to listen, and you can think outside the box, and isn't that what an entrepreneur is anyway? So it's a nice opportunity when you're negotiating and selling to think about, maybe I can try to get what I want, make it a win-win, and really have a good outcome without all the interim battling that often happens in deals.
I want you to know, I had not heard Deborah's story. It just happens to be per chance that now we have Michael talking about the relationship between the principals and the lawyers. Although Deborah has already told you, you can really, whatever Michael's about to say, you can just ignore if you want to, according to Deborah. Okay, go ahead, Michael. Try and rehabilitate this.
So it's when I take my kids to the track for the first time, I want them to lose, right? Because if they win the first time, that's how they're going to judge it whenever they go. They're going to think, oh, I can gamble because I'm always going to win. I want you to remember that when you're listening to that story. So everybody sees things through their own eyes, and I was going to say that part anyway, right? When you're a hammer, every problem's a nail, and so you get what you get when you're listening to me. I'm going to tell you about being a lawyer. What I get out of that is she had the wrong lawyers. That's the story I get, and that's part of what I'm going to talk about is how do you know you have the right lawyer and how do you have the right relationship with your lawyer. And of course, if you're inside and you know the business and you're getting a great deal, if you've got a good lawyer, your lawyer is not going to go mark up a contract like that. But I would say that in deal making, like in business, as you're running your business, you're only as good as your team, whether that's lawyers or financial advisors or whatever. Intuit had this large group of lawyers in-house, I'm sure, and they had sophisticated counsel. And when you do a deal with them and if you're trying to sell your company, most likely the person on the other side is going to have really sophisticated advisors, and you want to make sure your team is up to the task. You may be good enough, you may be incredibly talented, or you may be in the right situation where you're dealing with someone that you've been inside with for a long time, but you may not be, and so you just have to, I'm not saying that's bad advice, I'm just saying it's not always the right advice, right? There's not one size fits all. So every deal is different. Different players, different negotiating leverage, different risks, different timing, and so it's critical, right? And this is what you want to do: is sit down, right? If I was in that situation, I would have sat down with my lawyers and said, "Listen, this is a great deal. We're getting a great price. I know this business really well. I know what the liabilities are. The goal is to get it done quickly, and not to protect me on everything." And if you don't have that conversation and you just send the lawyers off and you have the wrong lawyers and all they're worried about is protecting themselves and they're not thinking a business way, then you're going to get something like that, a markup like that. And I send out markups like that sometimes, and sometimes I don't, right? It just depends on the circumstance. So let's just talk about what the functions of the lawyer are on a deal, and then you can see if you've got the right one. You have to think if your lawyer thinks this way, because not all lawyers think this way. So So the first, there's a very famous article written about transactional lawyers and how really their function is to act as a transaction cost engineer. And so what that means is, if you think about any deal, what a deal does is you're increasing the size of the pie. Intuit had a business that wasn't really doing much for them. In fact, it sounds like it was doing negative for them. And so they were able to get it off their books. It was obviously valuable to them to get it off their books. They had a willing buyer who wanted to create something of value. And so what you do, any deal, if it's a good deal, what happens is whatever the existed before the deal, there's more afterwards. And generally, that's more monetarily, right? Between the two parties, there's going to be more. And what lawyers do is good lawyers try to figure out, hey, what's important to my side, what's important to their side, what can I give up that doesn't cost me anything, that gets them benefit, and what can I get, right? It's a win-win negotiating, right? If you do it well, you're creating value. And there's many people who think that's the most important thing a lawyer does on a deal. Not protect you from the downside or anything like that, but to increase the value of the pie. So once you increase the value of the pie, then there's the pie splitting, right? So you've increased this value, and you have to figure out how you're going to allocate it between the two parties. In that, your lawyer's your advocate, right? The lawyer's got to figure out, so we've increased this value, we've made something that's more valuable. How do I make sure that my client gets most of that, right? And that really depends on the client. Sometimes client says, well, look, this is sort of the range that I want to be in. I don't want you to go further than that. I don't want you to advocate. Sometimes you'll have clients, they'll say, I want to get every last nickel off the table. It's up to the client. You have to decide what you're like. Next is, so third on the list is basically to watch your back, right? So emotions run high in deals. Business people get very excited. They sometimes they ignore or minimize risks, particularly because you'll have investment bankers or financial advisors or people in a deal who want to get it done for reasons that have nothing to do with the viability of the deal, and they'll minimize the risks. And so what an attorney can do for you is lay them out. Doesn't mean the attorney tells you you shouldn't take it or you should take it, right? But if you're good, you say, here are all the risks to the deal. If you do it, this is what we're doing, and here's ways we can minimize it, and then you make the decision. You minimize them, or you say, you know what, it's a risk I'm willing to take, don't want to upset the other side, let's go forward. Next, they can help you in the diligence process. So here you didn't have a diligence process, you know the business really well. If you're selling to someone, or any deal that you might do, if you're taking equity in from a venture capitalist, you got to know about the other side, even if it's only cash, right? If you're taking cash in from a venture capitalist, you want to know, is it a venture capitalist who treats their portfolio companies fairly, or is this somebody who really squeezes their portfolio companies? If you're selling your company for stock of another company, is it, and it's a private company, what good does that stock do you? How do you get out of that stock, right? Well, if it's a public company, they'll help you do the diligence on that. If you're dealing with individuals, they may know the individuals. So one of the important things, even when you're a seller, it's important to do diligence on the other side, and they can help with that process. And last, they can run the negotiations. Now, some people might say, gee, attorneys will ruin the negotiations because all they are is combative. And again, I would tell you, you've got the wrong attorneys if you're doing that. In general, it's going to be rare that you are experienced enough in the deal world to really know what the big negotiating points are, right? You do what you do best, which is run a company. Here are people who buy and sell companies day after day, right? I probably do, 20 deals a year. It's just experience. It's not that they're smarter than you. It's that they're more experienced than you are. And you're generally not going to be a match for really sophisticated buy-side people. They're going to have biz dev guys in-house, or they're going to have investment bankers. They're going to have sophisticated counsel. And so you need someone who understands that world so that you're not taken advantage of. That doesn't mean that you have to be a jerk or that you have to send a really heavily marked up contract back. But you want someone who can say, hey, this is what they mean when they're doing this, and you have to be careful of this. A lot of times when that happens, depending on who's on the other side, the other side will try to do an end run around your lawyer. And they'll say things like, they'll criticize the lawyer and say, oh, they're making a mountain out of a molehill, this isn't really an issue, you shouldn't be worried about this. And I think you have to remain disciplined and think about that as that's going on, and think about whether, I mean, you should talk to your lawyer about it. It might be true, sometimes it's true, but a lot of times it's not true. And all they're trying to do is take advantage of you. This is, it's particularly important if you're going to have some kind of ongoing relationship with the other side. So you can think about a situation where you're selling your business, and in the context of selling the business, you're going to enter into an employment contract. In my experience, you are better off not negotiating that employment contract by yourself, but letting your lawyer do it, because there are going to be contentious points. There just are. And you want to be friendly and agreeable with the people that are going to be employing you on a going forward basis, or who are going to be your business partners on a going forward basis. And so if you need to press points that are really important to you, and they're contentious, then you want that being done by someone else, so that afterwards you can have a good relationship. You don't want to poison that relationship. I guess the last thing I would talk about is when you want to get your lawyers involved. So you may start doing something and someone gets you a term sheet, and you may have this urge to keep costs low, which I completely get, and to mark up this term sheet or letter of intent or memorandum of understanding. They may call it a bunch of different things. But depending on the context, there are different strategies and considerations that people don't do this all the time, might not think of. So for example, when you're a seller, you want that term sheet to be as detailed as possible, right? Because your best leverage is then, and if you concede something on the term sheet, you can go back when a lawyer looks at it and you can say, I said this, but I don't want to do that anymore. And so you can retrade. It's done all the time. But it leaves a taste in people's mouth. And so you're much better off getting those issues up front on the table early on, if people are doing a term sheet, so that you can make sure that when you have the most leverage, you discuss all the things that are going to be important to you. The buyer's main goal is just to get you to take your company off the market. They want to have a term sheet that has almost no specifics in it. They just want to lock you up so you can't go sell to someone else. And then, as you negotiate the contract, you feel stuck. So there's that tension there. And if you don't have a lawyer involved, you won't know these things. And also, people can stick language in a term sheet that you think, oh, I'm signing this non-binding term sheet, it doesn't matter. If worse comes to worse, we just won't do the deal, I'll walk away. But people can stick language in that makes a term sheet deemed enforceable, right? So a binding agreement, you have to sell. Even if there's language somewhere at the top that says non-binding or something. And so you have to be careful because you're not an expert. I'm not saying everybody's going to do that, but I'm going to say there are people out there who do that. And you don't often, unless you're dealing with someone you know very well, oftentimes you're dealing with someone you don't know. You have no idea whether they would do it. So the lesson would be, once you get the letter of intent, I would get counsel involved, because you want to make sure that you're protecting your interests from the earliest part. And that's all I got.
Okay, we have 10 minutes. Any reactions, any thoughts, any questions anyone has of any of our panelists? Yes, sir.
This question is for Michael.
Okay, let me ask, can you stand and, can you all hear him or not? No. Okay, so stand and project, please.
This question is for Michael. Michael, if you've never, if you've never sought an attorney before, what are some of the things that you should be looking for in terms of, more than just, oh, this person has industry experience, or let's say in oil and gas, for example. What are some other things to look for besides that?
So it's so funny that you mentioned that. I was going to do a different, until I heard that, I was going to do something different. So I wrote down a list of important factors in deciding who to retain. So I think really important. I think industry expertise is expertise both in what you're about to do. You don't want to hire an M&A attorney to file your patents, right? You don't want to hire You don't want to hire a corporate person to do your litigation. So expertise both in whatever it is you're doing and in the industry, I think, is really important. I think personality fit is really important. Compatible working relationship. I think people who go in, I actually teach a course in venture capital, and I teach a case, and it's based on a true story, and it turns out that an entrepreneur goes in and is afraid to ask billing rates of the attorney that he's talking to as he's interviewing attorneys. If you're afraid even to ask what the billing rates are, if you don't have the kind of relationship with your attorney where you can ask anything you want, it's the wrong person. You want to make sure this is an advisor. This person, you need to be able to ask them any question and feel that they're going to be, that it's easy to get answers. You want to look, I'm huge into responsiveness. So if you're calling an attorney to try to get an appointment to set up an appointment to interview them to see if you want to hire them, and they don't return your phone call for 2 days, if they're not calling you back when you are a potential piece of business, they're not going to call you back when you're a client. And so you ought to look at responsiveness. You want to look at general business acumen, like I said. So there's it was beaten into me when I was a young associate that my clients do not make money if deals don't happen. So it was beaten into me that what we do is we make deals happen. I protect their interests, but it doesn't do me any good to mark up a contract where their interests are going to be protected 100% and the other side walks from the deal. That's not what I do. And so you want to find somebody who's like that, not somebody who's so afraid of taking any risk at all or letting their clients take risk that they actually substitute their judgment for their client's judgment. If it's important to you, and depending on what you want to look for someone who's got some kind of, you look at lawyers as like an information brokerage, network. So for example, if you want to sell your company and you need assistance in finding investment bankers or potential acquirers, you want to look for somebody who's, the truth of the matter is, if you own a business that's going to sell for $2 million, you're not going to come to me. I don't have those kind of connections, right? If you're going to sell a business for $50 million or $100 million or $1 billion, you might come to me because I've got that network. So you want to look at what their network is. And then, of course, you want to look at people. My grandfather was a cop, and he used to say this all the time, and I believe this to be true. You don't want to buy the bulletproof vest from the lowest bidder. So I'm not telling you that cost is the only. I usually get a bigger laugh with that than it's about. But it's true. He did tell me that. So I don't think cost is everything, but I think cost sensitivity is important. So I think someone who understands that you don't just do everything just for the sake of doing it because it costs you money. That doesn't mean you're gonna. I am expensive. I'll tell you that right up front. But what I'll tell you is that I'm efficient. And that what you get is you won't get wasted. You won't get wasted time. And so I think those are the things I would.
Any other? Yeah, please. Many of my students are in the very early stages of assembling their business plans. And Michael, you spoke to the term sheet and buying and selling a business. Can you speak a little bit to the term sheet when dealing with investors?
Yeah, well, I think it's the same thing, and in general, even if you're talking at angel level, if you're talking friends and family, it doesn't matter. But even if you're talking at the angel level, certainly if you're talking at the VC level, these people are very sophisticated. They do deal after deal after deal. They know they're very familiar with their term sheets. They know the tricks. There are tricks. It's unfortunate fact of life that your interests just don't align, and there are tricks in term sheets. And so if you don't know them, and almost by definition you will not, it's really important to get someone who knows these things so that you're not taken advantage of.
Yeah. And especially as a startup, when you're sitting across the table from the VC, because we do this a lot, you got to understand that there's two parts of the deal, right? There's the part where we negotiate, where our interests are not aligned, where you're competitive. And then there's the part after it closes, where our interests become aligned. And so from a startup perspective, these guys become your business partners at the end of the day. If you don't like them, if you don't get along with them, if you don't believe your two companies can work together, you're dead after the term sheet anyway. It's kind of the experience that she had. So some of the first questions we got is, you want to get the best deal you can, But then you also have to figure out some of those questions that I was talking about up front is why am I doing this deal? What do I get? What value do I add, et cetera? Because these guys become the business you're in for the next 5 or 10 years, and the next call you make to a lawyer is going to be, get me out. If you don't do this, sue these guys, get me an exit, bail out of this deal. So you are juggling two parts, and I completely agree with Michael that you've got to think about both the deal and then what happens as soon as it closes. That was certainly your experience, right?
Absolutely, yep.
And I found too that when you integrated the company, then, you know, all of a sudden the guys that you were ignoring their phone call because they're whining to you are now like, you know, the richest people that work for your company.
Right.
Yes, ma'am.
Hi. My question is, when you are looking at, when people are looking to either invest, buy, or acquire a company, I've heard a lot about finance, but how much do they value the intangibles of the business? So a brand, a culture, leadership, which really can give a competitive advantage to a company, how much value is that? Or is it not?
With Guitar Center, it was when we were acquired by Bain Capital, it was a huge part because there was this unique culture of how the company ran and what the customers were like and the customer experience. There was very few competitors that were anywhere near the size and and focus that we had. So they had an opportunity and they paid a huge premium to buy the company, knowing that that uniqueness could be leveraged down the road.
So of their culture and their brand?
Yeah, and the brand too, because I mean, there was at the time I think there was some 214 stores up and operating or close to that. Plus, the Music and Arts had 100 stores, and the company was doing $2 billion a year, and the next company in the list was had 50 stores total and was privately run. So there really wasn't any kind. I mean, ultimately, the big competition's coming from like small guys and eBay and Amazon nowadays. But they were able to buy a company with a brand that was nationally recognized, with a huge cash flow, with few competitors, and a unique culture of having high integrity, fun, and sort of a different way of entrepreneurially approaching things. And so they paid essentially what was the all-time high for the stock when they bought it.
And I would just say, ask why you're doing the deal. I mean, buyer or seller, why drives the answer to that question. If I'm doing it for cash flow and I don't care about brand, then it's irrelevant. If I'm doing it for any number of valid business reasons, why will tell you what the value is you're going to place or not place on brand and culture. Because sometimes you're doing the deal just to put for a competitive advantage. That's the whole point of the deal. And so you're really valuing brand and way over cash flow. Just depends on why, buy or sell, you're touching that transaction.
That was completely our experience when Intuit acquired us. They loved our culture and our environment. When one of our competitors has recently come toward me and is interested in acquiring, it's exclusively about putting us out of business and growing their top line revenue. Has nothing to do with our culture whatsoever. In fact, they would rather our culture not exist because they want to take us over. So I mean, two totally different extreme situations, and I think they probably vary as much as the acquirers vary, right? It just depends on kind of what their thinking is and their mind frame is.
Let me ask a question. Is the expertise and the assistance of getting a company ready to sell, is that available for, are there organizations, are there firms that do that for a piece of the action, a percentage or something, or is this upfront? Does it always have to be, is that part of the money you need to raise so that you can hire the people who are going to help you position this to sell to the bigger people? In your guys' experiences.
Are you looking at me?
Any of you.
So yeah, certainly there are companies. I mean, a lot of companies, even things like we do, where we're discounting rate to take paper. We're dragging paper a lot on deals all the time. I mean, being really practical, most startups cannot afford $600, $700, $800, $900 an hour. So you're gonna have to find, and there are people that will work with you, either wholly contingent, i.e., paper, or vastly discounted hourly plus paper to position you if they believe in your idea. I don't know that there's necessarily organizations per se that do that, but I'm not an expert in that one.
And I think ours is I agree entirely, and I think ours is an interesting situation because I think there are times, like I mentioned, when you can be outside the box thinkers. We, my corp, when we were first acquired, was not in a position to fund expensive attorneys. And so when the letter of intent came in, we said, we'll think about signing this. Can you fund our legal fees? And the inverse was true when I bought the company back. So sometimes if you're, like I mentioned, thinking outside the box, not in lieu of an attorney per se, but be creative about your options. A lot of young entrepreneurs aren't doing a $150 million deal. They're just not. And so when you're thinking about, a lot of us might think $20 million is a really good payday. So with that said, I think there are options out there that can support even a smaller business that might not fit, a really high-priced, high-level legal attorney.
And anyone that's going to charge you hourly to the detriment of the business's own cash flow is probably not the partner you want anyway. So if your business is flowing 10 grand a month and you're paying your expert 11, that just strikes me as bad math.
Let me ask Michael to take the last comment because our time's up. Michael, in my own mind, I'm thinking of, how do we shoestring this thing? How do we get by without the budget? And you're saying, well, I work on really big deals.
Yeah, you don't want me. Yeah.
Yeah, I know that, but you've already told us. But my question is, as I'm exploring, the way that we do this without affording you, have you run into people that operate that way that you think are capable, or do you think that they're?
No, yeah, sure. There are a bunch of people who. It's harder in Los Angeles than it is up north, right, or in San Diego. So you can certainly find the people up north or in San Diego. There are a few people in Los Angeles who do it. Most of them are refugees from large law firms. So you can get really sophisticated legal help for relatively cheap and also contingent. I would caution people on, I don't know how many of you have bought a house, but, you're always wondering, at least I am, maybe I'm just too cynical, but I'm always wondering, does the real estate agent really believe what they're telling me about this house and how I ought to bid a little bit more or take a little bit less? Or is it that they want to make their 6 or 8%? And I think that it's never ideal to have your interests and your advisor's interests not aligned. And it doesn't mean that you can't. Sometimes you have to. You don't have a choice. You can't afford it. But I think when you do it, you just have to keep that in mind, that it's not free.
All right. The one thing I want to just say in conclusion is that I don't think that real estate agents are supposed to charge 8%, but I thought 6 was the top. But if you say 8, I'll be surprised. It is time for our next presentation. Will you please join me in thanking these gentlemen and women who have shared their expertise?